Welcome to Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX and KWBY, and again on Saturday morning at 9 on KATX and KWBY as Angela Robinson joins Terry Slavens to share important financial information to help you live life on purpose. Insurance, investments, estate and tax planning, and much more. All covered now on Life Planning 101.
Good morning. Welcome into the show, Life Planning 101, right here on KATX, KWBY. Blakeney Hodges sitting in for Terry Slavens this magnanimous Monday morning. And we're ready to kick off. We've got Aaron Kennedy in the house and Matt Ervin. And what are we going to talk about today?
Hey, good morning. We got a full day of investing. I know the market's been pretty crazy, so unfortunately my sister is on the road right now. She couldn't be with us, so y'all got the second team of me. And I've got along a real treat for you today. I got Matt Ervin with you. He's my right-hand man in the office, helps me with all the investing and seeing clients and everything else. So it's going to be a real treat today. Kind of funny story, I have an intern that's in the office right now. We got somebody coming down from one of the financial planning schools here in Texas. Mm-hmm. And he spent the summer with us, and we were talking about individual companies. And I can't remember exactly what we were going over, but I was going behind the scenes of why this company was doing this and why it would fail. And I'm kind of blunt. And after I got through with my little spiel, Matt stepped in and said, okay, now that he said that, let me tell you what it means. So having Matt here with us, he humanizes everything I say.
Human decoder.
Yes. It's good to have him here this morning.
Well, thank you for having me, and it's good to be here. Good morning, everybody.
So before we get started, I wanted to kind of give you a background. I know we talk about this every single time, but it's so important. We as a firm are behavioral investors. We've been doing this for the last 20 years. As humans, we are simply designed to survive. You know, our human emotions keep us alive. You know, we live in this constant feelings between fear and greed. And whether we're looking for food or hiding from saber-toothed tigers, you know, we're always either in complete fear mode or complete greed. And it works, but it's exact opposite of what we should really be doing if we're investing. Those exact behaviors that keep us alive help us fail in investing. Mm-hmm. And that's why in the market average is about 10%, and the average person makes less than 2%. And that's because they're getting greedy at the very wrong time, and they're getting fearful at the exact wrong time. And we can probably see that a lot with what's going on right now in the market. Mm-hmm. You know, this market's been crazy, and we've seen it all over the board, people being up huge amounts or down huge amounts. Mm-hmm. And it's just our brains that's causing this to happen. And when I talk about behavioral investing, the other important part of that is investing itself. So when we talk about investing is being able to look back 10, 15, 20 years and seeing what you've built. And it doesn't matter if you're a small business owner, or you've bought a factory, or you're investing in your 401k. If you look back over a huge amount of time and see what you've built, that is investing. And that's what we do in this firm. We're not gamblers. Gamblers is looking back over the last month or the last year and said, how much did I win? You know, and if you look at it from that point, that really gets us back into the pure greed mode mm-hmm. of our behaviors, and it just doesn't work in the long run. So now that we've got that out of the way, let's talk about what's affecting the market this year. This year has been absolutely crazy, and it's been hard to wrap your mind around, period. We've had coronavirus happen, and, we actually shut down our economy for a lengthy amount of time. We've never done that in the history of our country, so there was a huge unknown how that was going to play out. And it's still a huge unknown what the effects of that are going to be. Mm-hmm. We've had this huge amount of government stimulus that's come in, and it was unprecedented of how much and how quickly our government stepped in and helped out. You would think, looking back over history, they would have sat in the House and sat in the Senate and debated until it was all over. But within a short amount of days, they had a plan together and money was out the door. So if you look back at what's happened, nobody could predict what $3 trillion being thrown into the market would do. Looking at it, we're shutting down the economy. People aren't working. Small businesses are going to struggle. We're going to see a lot of bankruptcies. People aren't going to be able to pay their rent, whether it's on their home or their office building. The economic effects of that are going to be devastating. But what did the market do? It did the opposite of what we all would think. So it was unprecedented. And not only do we have the coronavirus, but we have this constant assault from the media, this constant bickering with politics, and it's just
Exhausting.
Exhausting.
It will drain you mentally to scroll through your
Yes.
Facebook feed. It's like, ugh. Yeah,
Yeah.
it's nonstop from both sides, far and back. It's just,
Exactly.
it's too much.
And why? Why would anybody want to step in and invest at a time like this? How can companies do well with our world falling apart the way it
Yeah.
is? And that's really the way
Yeah.
way it feels. I have so many people that tell me I don't even watch the news anymore. I don't even get on my computer. It's just too painful.
It's depressing.
Oh my gosh.
Yeah, it's all out depressing.
So I think there's an opportunity here, though, because when you think about it and you talk to somebody, how does the stock market work? Most people are like, well, I hate it. I lost everything I had. Or, hey, I made money overnight, right? So they have some kind of contradictory views. But I think it's a great opportunity to see the stock market's full of companies, real companies with real investors. And you see things that are extremely undervalued right now, and you see things that are extremely overpriced still. So it's a good relation to see what is the stock market. It's made up of companies that we use every single day, and kind of realize that and bring it back to light of investing and give us maybe some motivation to invest.
Yes,
That's a
that
good
is
point. Yeah, that's a
exactly
very good
right.
point.
It doesn't matter what point in history we've been in, whether it was the dot-com crash in the early 2000s, the mortgage crisis in 2008. There was always companies that made money.
Yeah.
But, those aren't the ones we hear about, and those aren't the ones we feel.
Yeah.
Because if the market overall is down, it puts us in a real depressing mood. But Matt is exactly right. The market is a market of companies. And I think we've talked about this tons and tons of times, is that, the market goes up because people are buying certain securities within that market. And though those same securities are companies, they go down because more people are selling them. And it doesn't necessarily mean it's a good company or a bad company, but what are the masses doing? Is there overwhelming buying pressure or overwhelming selling pressure? So that's something that's really important to keep in mind. If we look at everything that's going on and then dig into the market itself, it's actually mind-blowing what is actually taking place. We've been telling this story in our office that companies that are more the work-from-home companies, the big tech companies that can still earn money while you're sitting on your couch not leaving the home, those have done extremely well.
Yeah.
I mean, all of them. And it doesn't necessarily have to be work from home. Just look at Domino's Pizza. They have knocked it out of the park,
Yeah.
But it's the same theory, They're making their money from people sitting on the couch, picking up the phone, calling them, and they're delivering a good to you. Just like Amazon, just like the cloud computing companies, just like some of the teleconferencing companies, all of them. If you don't have to get out and you can use technology from wherever you are in the world, they've killed it.
Yeah. Totally thrived.
But, those have done extremely well. But if you look on the flip side, and we're going to call these our travel stocks because those are the easiest to understand, those have been decimated. So, cruise lines, I know that's been in the news a lot. Airlines, rental companies, a lot of your big industrials, energy companies, anything, the older economy has been sacked pretty much. And if we look at the market on an even playing field, and that means if we take every company in the S&P and give them equal weights, so we look at what the average of all companies have done throughout the year, those are still down. Those are still down close to 5% year to date. Where if you look at big tech, it's up close to 30. How does that happen? And if you look at just strictly the travel stocks or the economically sensitive stocks, those are down over 20%. So there's a huge discrepancy in what the market's doing And depending on what side of the market you're on or where your beliefs are, you're either extremely happy right now or very, very depressed, and you probably need to go see a doctor. You know, it's not good.
So talk a little bit about that and how we find that mixed bag with risk, and what are some of the tools that we use to make sure people stay invested. And I want to give this short story. I was sitting with Aaron. We were talking to a client one day, and Aaron said, if somebody asked me what my job was, and I was like hanging on the words, I was waiting to hear what he had to say because it was so just exhilarating. It's like, what is your job, Aaron? He said, to keep people invested. And the biggest thing we do that is get your risk right. Can you talk a little bit about that in this environment?
Sure. The risk is the most important part. You know, I was talking about fear and greed earlier. The objective is to get it just right, where the market, no matter what it drops, we have your risk right where you won't drop more than your breaking point.
Gotcha.
And that breaking point is you giving us a call and saying, take me to cash. I can't do this anymore. So if that happens, we know we've lost the game, and then we're going to lock in those super low returns. You know, but just on the flip side, our human behavior is not just fear. We have greed too. So on the flip side, we have to make enough money in the portfolio when times are good that you don't call me and say, put it all in. Because if that happens, we know we got that part wrong too. You know, and more than likely, you're asking me to put everything in after the market's had this huge, amazing run, and greed's taken over, and we know most of the time greed takes over at the wrong time.
Mm-hmm.
So the main objective is to get the portfolio built for the individual person. And I like to say we need to build the portfolio to get the return that you deserve, you know, and that means if your risk says, hey, you should be making 7% long-term with this risks of stocks and bonds, that's great. If your long-term return should be 4 because of your risk level and we should have this mix of investments, that's great. What we don't want is to get below that 1.7 or 1.8 of what our human behavior is going to make us do if we run off of emotions. So it's a very, very delicate balance. And, you know, even through this coronavirus and everything else, it's worked out amazingly correct. You know, our risk levels, it did go down to the bottom side for everybody, but that's what we were planning on. Mm-hmm. You know, we have these conversations every single time we meet because things aren't rosy all the time.
Yeah.
You know, they feel good when they are, and, you know, we're all smiles, but eventually something like the coronavirus is going to happen. Sometime Y2K is going to happen. Sometimes the mortgage crisis is going to happen. So we have to be ready for that. The market will be surprised, but I don't want our clients to be surprised. And as an investor, you should not be surprised when the market goes down.
Yeah.
Because it happens.
When I talk to clients about risk, it can mean so many things, and it means something to us that it may not mean to somebody else. But I like to say it like this. If I'm not originally from Texas, so nobody get offended, but if you like riding the Texas Giant, you know, that could be, you know, a fairly volatile risk, and then I'm more apt to go jump with my kids on the teacups and ride just kind of some nice, easy ripples. And, you know, but there's a balance in between there. You know, what are you okay with? And one thing that we always talk about is it doesn't matter if you're riding the teacups or if you're riding the Texas Giant. It's going to hurt if you get on or off at the wrong time. So we try to be strategic with that. And one thing is, you know, people need income in retirement, right? Mm-hmm. And so how do we make sure that we have that? And one thing is we have our income buckets. So Aaron, can you talk a little bit about our income buckets and how we might utilize some of these strategies with that?
Yes. So going back to it, we like to not necessarily trick our psyche, but we want to reassure everybody that things are going to be all right. So one of the ways we do that is we use the bucket strategy. And if somebody needs income, you know, whether you're retired or setting aside a house payment, whatever that income need might be, we hold a year of that in cash. Whatever that, if we're sending it out monthly, bi-yearly, or even once a year, it doesn't matter. We want to hold 1 year of your income needs in cash. And after that, depending on your risk level, we're going to hold an additional 2 to 5 years, or maybe even more, in securities that aren't necessarily affected by the stock market. Our real goal behind this is we don't want to be forced to sell anything at the wrong time. Mm-hmm. You know, because you can't predict what the market's going to do. Sure can't predict how the market's going to act on any certain amount of news. So if we have that safety built into the portfolio that, hey, yes, the coronavirus happened, but we still have 5 years worth of income
Yeah.
in a safe spot where we don't have to sell at any kind of distress levels, that puts people at ease, and they don't have to make drastic decisions ever. And, we look at this, well, me and Matt look at this on a daily basis, but,
Yeah.
overall, when we're doing our big rebalancing, we at least go in there once a year and make changes, at least once a year. And with those changes, we're usually taking money off the top, taking our gains, taking our winners, and either buying more income or picking up something that hasn't really performed as well, that we have some high conviction in, that we can make money at a future date. We like to buy low and sell high.
Yeah. It's always the goal.
Always the goal.
That's
Yes.
the plan, right? And one thing I'd like to throw in, it's a lot of it is you're hearing a theme about discipline and behaviors. And it's always important that we, behave ourselves into ways that we never have, and that way we can achieve things that we never have achieved. And so some folks that have maybe questioned, well, what is the market? There's the place in the market for everyone, and you can hear how we can help with that based on your risk tolerance. It may be cash equivalents on up to the Texas Giant if you can stomach it. So I think that's wonderful. Is there anything else you want to throw in about?
Well, going back to that, we don't just target one type of people. Everybody is an individual, and really no individual is wrong. So I like to say there's a million ways to skin the cat. So no matter what your risk level is, we can design something just for you to help achieve your goals. We may have to tweak your goals a little bit if they're unrealistic, but once we get to the baseline, we design basically anything for any individual out there. But it all goes back to that risk level and who you are as an individual. So that is the most important part, like Matt was saying earlier, is to get that risk just perfect.
And it's wonderful because we want to help people live life on purpose. And by doing these things, staying disciplined, having good behaviors, having a coach in your corner that helps you stay rational amongst times such as these, and make you want to make some decisions that maybe normally wouldn't come to your mind. You need a sounding board, you need a coach. We offer that to our folks. And there's an article that comes out every week in correlation with the show. And so I want to kind of give a teaser for that because I think it makes a very good point. And it's all about finding the perfect investment. And I hope Aaron doesn't panic because when I say perfect investment, that throws up a red flag, right? He's sitting here shaking. But basically what it boils it down to, and he touched on it briefly, but what is the most important thing? Money is a tool. And of our 8 life planning issues, it's the last thing that we talk about because it is a tool to help us reach our goals. And so I'm going to give it away, but I'm going to let you read the background story, but there's only one perfect investment, and that's family. And so to kind of shrink this up a little bit, I found myself doing it. I've seen Aaron doing it. I've seen other folks doing it. So during times like these when, we can't run off and go to the movies or maybe run off and go do a water park or something like that, we invest the time in our families and make experiences. So that's one thing I'd like to challenge everybody today is maybe you have already or maybe you want to start a new family tradition. Find out what's the most important thing, and you might find something that goes on forever. I think that's something we can all take from and make sure you're focused on the most important thing and stay disciplined.
Let me take a quick break real quick, and then whenever we come back, we'll have a few minutes to wrap everything up. Does that sound good?
Perfect.
Sounds good.
Okay, y'all keep it tuned here to Life Planning 101 on KATX and KWBY. And welcome back in to Life Planning 101 right here on KATX, KWBY. A few more minutes of pretty much market talk.
Yeah.
Stock market, that is.
Market talk. Let's get on into the numbers here. I know we've spent a lot of time on why and how we do things. So let's talk a little bit about what's going on. Always get a chuckle reading the financial news every day. They always have a reason of why the market's either going up or going down. Like somebody in the media is predicting what is going on.
Mm-hmm.
It always tickles me. But that reminded me of, I was reading the earnings report. We're right in the middle of second quarter earnings right now. And I was going through the beats and the misses, and, it all sounded fantastic. 83% of the companies have beat their revenue or their earnings in the second quarter. And on average, they've beat by 22.4%.
That's a big deal.
That's a big deal.
Given what's going on right now.
Yeah, that's most in history since I've been tracking it. That's huge. Even the revenue or the sales have beat by 1.6%, and that's the best that the market's done in the last 5 years. That's incredible. But, okay,
There's always a big huge
here's
but.
the flip side. Even though they've beat their expectations, earnings are still down almost 34%, and that is the most since the first quarter of 2009. Revenues are down 9.8%, and that's the most since third quarter of 2009. So even though you hear some really rosy reports, they might want to read the disclaimers or everything else, so. But something to really look at if you really look at what earnings and revenues are down, it hasn't been this bad since 2009. If we look back at 2009 was the second quarter of 2009 was actually the recovery of the mortgage crisis. Mm-hmm. That's when we took off. So even though earnings are bad and our revenue figures are bad, doesn't mean the market is going to do bad. If we look at in 2021 and 2022, a lot of expectations are earnings are going to be growing by 22% a year, which is massive. Mm-hmm. So, that's really what the market should be pricing on right now. And one thing we're really watching, two things. Number one, if the Fed comes out and puts more money in our pockets, if there is another relief package, mm-hmm. that's going to do wonders for the market. And if that happens, more than likely you need to be part of that.
When we look at, I find it interesting, we got to get some stuff opened up with some forward thinking, because we even tried to book a flight into January and they couldn't do it. You couldn't do it.
Yeah.
It seems like just a few months away, but the uncertainty is still there. So mm-hmm. I think when we start seeing some of that confidence, because people will fly again, people will travel again.
Yeah,
that's going to happen.
That's just a matter of when.
Yeah, and that's the big story. We're going to see this huge change from these tech stocks that have been soaring to more cyclical, or the travel stocks. Don't know when that's going to happen, but when that confidence comes back, these companies that have been beaten up so bad are going to return to normal. They might not excel, but once we get the idea that these travel companies or these deep cyclical companies are not going to go bankrupt, they're going to be priced back to normal. Mm-hmm. Just getting back to there is going to be 25 to 33% returns. And if they can grow earnings after that, it's just going to be icing on the cake. So back to our behaviors, maybe going into these huge tech companies that have been doing so well, maybe it's not the time to be doubling up on that. Because if we look, these tech stocks have not been this expensive compared to the rest of the market since 1999. That was not a good year. I mean, they got priced astronomically high. And not to say that history is going to repeat itself, but tech stocks dropped about 30% for 3 years in a row after that. There's a big difference between how that market is today versus back then, so it won't look exactly the same. But there's no reason to believe that some of this air out of this tech companies will come out. Or let me put it this way. Some of the money that people have been investing in these tech stocks will come out of those companies and move to more cyclical companies or smaller companies, the companies that have been affected the most through this downturn. And that's really where we're trying to position ourselves right now. And that's kind of thing as Matt was alluding to, how we're constructing our portfolio so we can get the best of both worlds, and not have our portfolio act one way or the other.
We got to stay disciplined, and you got to ask yourself, if you're making a decision, why am I making this decision? If you have questions, give Aaron a call. It'd be great.
Let's give the y'all's website, though, before we sign off.
Kennedy-financial.com. You can find Life Planning 101, the podcast. It's on all major podcast downloads, iHeart, iTunes. There's many more. We have weekly life lessons to your email every week. It's great, full of information, good ways to get in touch with us should you have questions. And I think that... wrap it up, Aaron.
Yeah. If you do, we talk a lot about risk, and if you wanted to get on and see what your actual risk score is, you can get that as well. if you wanted to see what your risk number was, you can get that right off our website as well.
Perfect. We'll head over.
Thank you for joining us for Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX and KWBY, and again on Saturday morning at 9 o'clock on KATX and KWBY for more Life Planning 101.
Advisory services offered through Smart Money Group, LLC, a registered investment advisor. Securities offered through Calton & Associates Incorporated, member FINRA SIPC. Kennedy Financial Services Incorporated is an independent of Calton & Associates Incorporated and Smart Money Group, LLC.